Welcome to today's review of the True Potential portfolios. My name is Chris Leyland and I'm an investment director here at True Potential. So the format today is that I'm going to spend the next few minutes talking about our flagship investment product, that is the True Potential portfolio range. First, let's start by discussing the performance of the portfolios. We'll then look at what are the key themes we're seeing from our fund manager partners, and finally discuss what changes have been made over the months of the portfolios. Okay, so looking at the month of February, the portfolios have lost a little bit of ground, with the lower risk portfolios outperforming the higher risk models as markets digested the sell-off earlier in the month. Over the longer term, the figures continue to be strong, and if we look at performance since launch, that's October 2015, aggressive clients have received over 40%. Moving on to the performance of the underlying funds that make up the portfolios, the new True Potential 7IM fund range has performed well, coming back after a weaker performance in 2017. Their positioning of being underweight equities and bonds, overweight cash and alternatives has helped them fare well during the sell-off. The True Potential Close Brothers fund range also held up well, with Close Brothers' excellent stock picking abilities coming through. Looking at the key themes, which are formulated after speaking to our manager partners, our managers have continued to remain positive on the economic outlook. They feel, in general, that the sell-off in markets in early February was a correction rather than a signifier of something more sinister, with actually many of our managers opting to use the pullback in markets to access assets at favourable prices, although others are still waiting until we see a little bit more stability in bond markets. The main conclusion is that the higher level of global economic activity being experienced is not correctly aligned with historically low interest rates designed to combat the lower levels of growth experienced after the credit crisis. As global growth and monetary policy realign towards historic norms, financial markets are likely to experience volatility. However, it's important for investors to remember that higher interest rates are in response to the proof that economic expansion rather than that actually we've got a fear of higher inflation. Looking at the changes that have been made over the month, these have taken place within the defensive, cautious, balanced, cautious plus and balanced plus portfolios. And what I'll do is I'll just summarise the changes overall. So firstly, Allianz, we've reduced Allianz across the board. Allianz use a momentum style, and that's something that's worked very well when there are clear trends within markets, when markets are rising. However, as we look forward through 2018, and look towards a market environment of rising interest rates and policy normalisation, it was felt that this style could come under pressure compared to the lower risk managers. Next, Schroders. So overall allocations have been reduced. Taking an asset allocation view, the funds have been positioned very well, but stock selection has struggled. Also, the fund carries the highest cost out of the True Potential Wealth Strategy Fund range. Next, UBS. So allocations have been reduced here within the defensive portfolio only. And that's because the fund is exhibiting slightly higher volatility compared to the other funds within the risk category. And that's as a consequence of UBS's high weighting towards equities. Close Brothers. So we've added to Close Brothers within the portfolios. As we move through the market cycle, stock picking managers can take advantage of stock and sector disparity to access assets at favourable prices. Their growth style has worked well, and it offers genuine diversification from our more value-focused managers. So looking at 7IM, overall allocations have been increased. So 7IM have a larger allocation towards alternatives, but particularly as an alternative to bonds. The alternatives allocation looks to offer both stable, above inflation returns, and the potential to offer uncorrelated performance to both equity and bond markets, a way to help mitigate risk in changing market conditions. Next, Goldman Sachs, and we've increased the allocations towards the True Potential Goldman Sachs Balance Fund. The fund is positioned short duration, so less sensitive to movements in interest rates, is well diversified with alternative investments, which should help to mitigate risk. For the rest of the portfolios, no changes have been made, with the four optimization factors of risk, cost, expected return, and risk-adjusted return always being paramount. In conclusion, moving forward, markets are adjusting to a new environment of normalisation with interest rate policy, but with the backdrop of a very strong economic growth. Diversification is very much key, spreading risk both by geography, asset class, and with the True Potential portfolios, fund manager style. Thank you very much for listening today. and I will speak to you next time. Thank you.